Thanks. And thanks also to the previous speakers. I think you touched upon some points that we will also see now reflected in this presentation. I'll also don't show any numbers and tables, but more talk about conceptually how to link climate disaster risk financing and insurance and social protection schemes, drawing on examples from different projects that we have, but also different research studies that we have done or that are ongoing. So to start with, and I don't know everyone's background, but I want to start with what is climate disaster risk financing and insurance. So we refer to the toolbox of financial instruments and strategies and solutions that aim to improve the financial preparedness and resilience of climate vulnerable or communities and countries and individuals vulnerable to climate and disaster risks. And the central goal is really to assist more rapidly and more reliably. And I'll talk in a minute about climate risk insurance specifically and parametric insurance and how this is, actually looking at that point to pay out quickly. Yes. So what we're focusing on here is climate risk insurance, so protecting vulnerable communities against these type of climate risks that you're all aware of: extreme wind, excess rainfall, flooding, drought, heat waves, high temperatures, all of those. So with traditional insurance, you would look at what is the damage. You have to assess the damage, which can be costly. Then a claim is submitted to the insurance company, which looks at it, and then it's decided how much can be paid. This process, as we know, can take weeks, if not months, if not longer. So the beauty of parametric insurance in comparison to that is that there's a predefined model where we say communities or individuals living in this region that have insurance will get a payout automatically if certain weather indices are met in this region. So we will look at satellite data and say, for example, if there is in this region 5 days of rain with this intensity, then automatically everyone that has an insurance policy in that region would get a payout. So what that does is you take all of the work sort of before something happens and prearrange, and then payouts can happen within days after something happens. And you can even speed up the process more by using, for example, mobile money or other digital payments for communities also that might not have access to bank accounts or don't have that. So here I just want to quickly talk about the pathways, how climate risk insurance can help build resilience of communities and individuals. And you could think of different dimensions. One is it can help them anticipate climate impacts better and also take then risk management measures to do so, to absorb them better. So to absorb climate impacts, you have timely finance after an event. And what we know as well is that the financing costs for recovery increase the longer you wait with an intervention after an extreme weather shock, right? So it's crucial to be as quick as possible at the beginning, of course, for immediate help, but also to minimize the costs. And also then to adapt to climate impacts, help increase savings, help increase and improve creditworthiness. And some of these aspects we also see, we have done, for example, a study in Fiji on the use and impact of climate risk insurance payouts there to individuals. And what we see is that people also, it alleviates anxieties linked to risks and also their uncertainty. And with that, of course, can also then help, for example, spur more investments and investments, I'm not meaning big investments, but also in resilience. So now on actually approaches on integrating climate risk insurance and social protection. So this is drawing on a study that we have done with colleagues on their project for UNDP, looking exactly on how to integrate best to make social protection systems shock responsive. And we did interviews with different policymakers and also with different actors in 4 different countries. So the main reasons for integrating are the following. Of course, filling financial gaps when shocks occur. That can be for a country, right? Fiscal stability, but it could also apply to to other levels. We want to facilitate shock-responsive vertical and horizontal expansion of social protection programs. Vertical would mean existing social welfare beneficiaries get more, sort of more in-depth support when an extreme weather event or a shock occurs. Horizontal would mean expanding the beneficiary base to other vulnerable populations that are maybe traditionally not covered. We want to protect the poor and vulnerable, of course, from disaster risk, be it climate or other disaster risk. Strengthening also the underlying causes, partly of poverty and vulnerability with addressing climate risks. Preventing negative coping strategies. People might have to resort to selling their assets, taking out their pension if they don't have access to support. And then, establish an optimal mix of risk finance and insurance options. So on the following slides, I talk you through 3 approaches of doing so. One starting from the macro level, then meso, and then macro to micro. So this one is the government, right? So in the first case, the government could take out a climate risk insurance from a regional risk pool, and then gets a payout when there's extreme weather. Let's say there's a cyclone hitting a country, and then that money goes first to the government. And then if there's a provision made, that some of this payout would be channeled to social protection, then the money gets forwarded sort of to the Ministry of Social Welfare, and only then it comes to the beneficiaries. There's a case, of course, for doing it like that, but it takes time. And an example, and it was mentioned earlier already, the African risk capacity is one of the 4 regional risk pools for climate risk insurance that exist globally. There's also one for the Caribbean, for the Pacific, and for Southeast Asia. It's a regional risk pool that was launched in 2012, and that provides climate risk insurance to countries across Africa. And it supports then the countries also to meet specific needs and capacities. And partly there are provisions made then for social protection specifically, and social protection programs are used as a delivery channel to channel these payouts. Then the meso level, similar, right? We would look at meso level actors. So that could be humanitarian actors, such as World Food Programme, START Network. That could be agricultural cooperatives, or companies taking out insurance for their members. So all type of actors that are between the national level and individual level, they can take out an insurance policy. In the case of an event, they will receive the money and will then forward it, through to their members. So examples of that, again, I want to mention the example of ARC Replica, it's called. It's basically functions almost like on a national level. Instead of a country, humanitarian actors are taking out insurance for the members and then channeling those directly to their members. And in Africa, we have examples in different countries with WFP and the START network. And also want to mention one example in Fiji of a program where we work with UNCDF and UNDR, where an insurance is given to different cooperatives and it has an anticipatory component. So based on the forecast of a cyclone happening, there can already be a payout to the cooperatives, and then they can make provisions to support their members even before something happens to reduce the risks. And then the last one is macro to micro, where government pays for the premium, but then the insurance policy is actually given to the individuals themselves. So this means that the payouts are also given to the individuals themselves. And to our knowledge, this is the first time it's ever done in Fiji at the moment, and with that, it goes very directly. Within days, we can pay out to social welfare beneficiaries in an event of extreme weather event. And we are, with other researchers, also looking at this. So this is now in the 3rd year, expanding access, and we're looking to rigorously assess that actually with an RCT and the baseline this year. So what are the entry points for integrating the two, and what do we have to start looking at? So it's important to mobilize stakeholders in both spaces, in social protection and CDRFI, to identify existing programs that can offer channels to add climate risk insurance to it, or other disaster risk financing solutions. Retrofitting of existing programs that are already there. We don't always have to establish new ones. Strengthening, of course, also country-level data and monitoring evaluation systems to facilitate the use of those payouts, also for the targeting, for the monitoring, and to use that for development purposes. And then, importantly, also to initiate measures to address cross-cutting aspects. Gender sensitivity and inclusion, of course, are also important points. I know we don't have much time, but also want to mention one program we have worked with different government actors in Indonesia, actually, to establish a roadmap for adaptive social protection. So adaptive social protection combines these three areas and integrates social protection, climate change adaptation, and disaster risk management. And establishing that on a national level means also to don't only talk to the National Disaster Risk Management Agency or only to the Ministry of Social Welfare, but to bring everyone together and see how this can be established for a roadmap. And it's actually integrated now in the new social protection reform. And with that, I'm at the end of my presentation. Just want to mention an event that we're organizing end of June to exchange on knowledge and sort of the new evidence in the disaster risk climate and insurance space with different researchers and practitioners to look at what's the evidence over the last 3 years, and what do we learn from that and take it forward. And thank you.